Okay. We'll call the meeting to order of the May 24, 2023 meeting of the trustees of trust funds. So first item on our agenda is Kathleen, and we've got two items to talk to you about. We'll take them in whatever order you want.
Normally, I just jump in ahead of your minute approvals.
Yeah, no, we've got somebody else coming in at 8, and so
Okay.
we're going to take stuff out of order. So.
Okay, great. I'm here on the Mortimer scholarships, which Peter and I met, I don't know, within the last month, I guess, with the big influx of cash as a result of Bill's estate settlement. The money can be of much more value to many more students. So the language in the original 2 scholarships was very limiting to $1,000 scholarship. And the Mortimer 1 was payable after the completion of the first year of college, and that was something Bill had talked to me about just before he passed. He wanted to make it a 4-year renewable. And he passed away, sadly, before any of that happened. So I have had preliminary conversation with Diane Quinlan, the Director of Charitable Trusts, and towards that end, I drafted and sent to Peter, who I think forwarded along, a non-judicial settlement agreement, which would be a way to do this without going to probate court, and it would be quicker. And Diane understood, and everybody was just blown away at the amount of money Bill left in his estate, which was the residuary of his whole estate. So the documents before you, that would have, I just drafted the one for what we referred to as number 1, but it was really the original. And then he called the second one Mortimer 2. So this would make the change to make it payable for a full 4 years, eliminating the need to wait for an additional, the completion of the first year, and make it clear it was renewable. The original didn't say it was or it wasn't. People just did reapply and were considered as if they had never applied before. And what I wanted to speak with you about, Peter had kind of ballparked that the amount in there now could, and correct me if I'm wrong, could do 2 scholarships in each for 4 years renewable in the amount of $2,000. Did I get that right, Peter?
Yeah, and then
Roughly.
I read some numbers after you and I talked, or I got your email. We actually could do up to 3,000.
So that's one of how we word this. I want to give us the flexibility
So
to do that. So that,
although with the stock market today,
I know, we'll be lucky to give 500, but I'll stop. So it's paragraph 15, which would be where we would talk about the language about increasing the number of awards, because we have a lot of scholarships written that way, depending on not usually the amount of students that would get it, but the amount to be given based upon earnings. So I didn't put a number, that it just could be increased if the stock market ever turns around. And so I put renewable up to 2,000, so we can change that to make it more flexible. And then Judy kindly, quickly gave me the figures of what it was worth before we got the deposit and after. So, it went from roughly 75 to 80 to over $500,000 each.
your intent would be to send in the changes for both Mortimer 1 and Mortimer 2
Yes.
at the same time?
Yeah. I just didn't draft the second one because we were going to change. The language will be very similar, except for the removal of that payable after the first year of college and the original Mortimer one. And I had explained to Diane Quinlan, the director, that, well, Bill was a close friend of mine, and to the day he died, he just was so concerned about the cost of college and the burden that it had on young people. And when he was at Edgewood, he had one of the healthcare workers there type a letter to President Obama about it. And he was very proud of having done that. So, and you can tell by his estate, he just really wanted to impact this problem. And the kids who got it, his room had pictures of them coming to visit him. They would send him letters, and stayed in touch with them long after, some of them even after they graduated. So it's a real testament to him. So Tom, you're the other lawyer at the table. Do you have any suggestions on how to make it flexible enough to accomplish?
Well, so as I explained to Peter on the way in here, because of my schedule yesterday with Little League games and the Celtics, so I didn't look at this
Life of a
until
retiree.
late last night. But, so I'm assuming that this is not intended to change the provisions that say that the person has to be in good academic standing.
Correct.
There has to be a demonstration of financial need. Those things are the same.
Yes.
And so, just quickly looking at it, the first thing I just sort of jumped on is the limit to $2,000 a year. So
I put that in the email. to
No,
Peter.
I understand. So the next draft wouldn't have any limitation or?
Well, we'd have to have some parameter. We have in other ones that the trustees can adjust the amount up or down based upon
Market conditions.
market conditions.
Yeah, I would say something like that, rather than, if it gets really good, I mean, and the numbers I wrote, we could do 3,000 based on today's thing, so.
I've read your numbers, but how does that impact the principal?
Doesn't.
It doesn't, it's all,
This is all off of interest?
Yeah.
He's basing it off of interest. So the principal is the 536,
36.
and then he's saying if the market was good and was earning, what, 3%, 2%,
Yeah,
or
he's
whatever
got
it is.
15,000, 16,000 a year.
Yeah, so,
But at 1 year, you got up to $24,000.
That's right, but if you look at it, in
You're not
the first
spending it
2
all.
years, we're only giving out 2.
Oh, okay, I get it. So 63,
yeah,
okay, I
yeah.
get it.
Peter, Peter and I were on futures for years and years and years, and they were renewable. We committed to kids for 4 years, and we would run these numbers every year about how many, when we took on one, in year one, we had to make sure we had enough to commit to that 4 years for that student. So it'd be a
Yeah.
rolling analysis of, so
Okay.
by having it be totally flexible, if we had kids in college, say, who started at $2,000 a year, because that's all we could afford, and then, do you use a 20-month rolling average here? How do you, like?
No, we don't do that with scholarships.
Okay, all right, so you would look at, and so kids who come after, say, in a freshman year and the market's great, you might be able to do 3,000, but if it was bad, you might have to limit it.
It's based off of the prior year, what we've earned, what the market did as of the MS9.
yeah.
And then what the market looks like the month before
In
the
February.
trustees are looking at it, yeah.
So am I correct in assuming that these awards are from principal only?
Yes.
And never the
No, no,
principal?
no, opposite.
The opposite.
Yeah.
The opposite.
Yeah,
I'm sorry.
I knew what you
That's
were
what I
thinking,
meant.
but I heard it wrong. Yes,
Yeah.
just income.
Yeah.
And this has the potential to be, significant.
What happens though, okay? And I read the other one that's on the agenda, that people don't even know who this person was. What happens 40 years from now? We'll all be gone.
It's kind of like the demerit scholarship.
I was just going to say
wouldn't it be?
Gray
Gray,
and
which are huge
the fire
scholarships.
department does the Kogan one.
Kogan,
So we
yeah.
have some that are significant because they were started so many years ago and they've just grown and grown and grown.
So it's ongoing.
Yes. And the people who knew him, he'll just be a name, but that, he just wanted it to be ongoing and to be available. That was his intent, certainly.
So, well, my question, I guess, is why are we putting in a number at all? It seems to me the problem with Bill's current ones is that, particularly the first trust agreement, is that it has $1,000 per year, and in that case, only one recipient. But and then the second one still has that mechanism that the principal has to find that why don't we do what we do with demerit and the other ones where we simply say this is the amount of money that's available, and we're leaving it up to the team over at the high school to decide how many and how much. So they, for instance, may decide they want to give $5,000 to 2 people instead of $2,000 to 5 people, or something like that.
I see what you're saying. As far as the number of students.
Well, either way, the amount and the number of students, what's holding back, particularly that first trust agreement, is that there's only one student and it's $1,000, and that means we can never spend the money.
And at the time, it was a corpus of 5,000, so it was going to be years.
But I'm trying to
Yeah,
figure out, now that we're here, why would we just simply increase it to $2,000 or $3,000 and not just make it all available and allow the,
I think the demerit scholarship is worded so that the trustees have the flexibility based on, it says that you can't use the principal, but based off of the earnings that they can, and they do, determine the amount. I'll come in and say, okay, it looks like about 28, but you've got some window, you can make it 30, you can make it 26, depending on where what the market's doing now, and we want to be conservative or whatever. But there is a flexibility there that, if the money's there, I think is what they're saying. 10 years from now, if the money's there.
Well, I think, and I think Tom's point is, well, how they dole it out might not necessarily be a decision around this table, but
Exactly.
by the committee at the high school. And you always would designate the amount available for spending.
so it seems, again, this is just my opinion, but it seems to me what we're trying to deal with right now is too many constraints on the ability to give out the earnings on the principal. And so the important accomplishments are to clarify that students can look forward to getting this for multiple years, because I think what's happening right now is the school is giving everything out to the freshmen, and then they're on their own, and
Most scholarships are written that way.
yeah, exactly. And so I
Just have a
think
few.
clearly Bill didn't want that to be the case, and I think only because he never envisioned having $500,000 in each of these scholarships, he limited it to 1,000. So I think if we're trying to fix this, we don't want to put another number like 2,000, because I think we could get ourselves in the same thing again and come back and say, well, we should have said 5 or something. So
Well, that was a placeholder thing.
yeah, no, but
So we could just,
Why don't you go and check on what the demerit and the Kogan and how that trust is worded?
Well, on number 3A, wouldn't it be resolved if you just said, parties agree trustees can increase the number of renewable, I'd add renewable awards each year based upon the available income, period.
But the problem with that is we're making decisions on awards, and that's what we've traditionally allowed the school department to make the decisions on who gets them and how many there are going to be on the demerits and stuff like that.
I can rework the language to accomplish
Yeah.
that.
You see what I'm
I
saying?
do.
Yeah.
That's a good point.
I don't think we want to be saying,
I agree.
you know, there are 5 applicants and, you know. So, well, I'd like to get other comments, but I'd like an opportunity to chew on this a little
Sure.
bit more, so.
Well, I have to talk to Diane again anyway before any paperwork would go to her.
Well, I'd be interested in, if you want to play around with this a little bit more and then and put together the one for the number 2, and get those out to us. If you can get them this week, because I'm going to be on vacation starting the 10th, I can look at them, you know, next week and get you back my comments and send them to you and everybody, and then we can take a formal approval on them at our next meeting in June or something, but,
And I don't want this to linger, but, you know, it's going to be, the impact is going to be next spring.
so that's right, because we're not going to decide until next,
They've already been given the amounts for this year, which
Right.
was 1,000
Right,
per,
yeah.
so
So
it'll be
next.
24. Right.
And all of them, you know, have been given out already, so.
Yeah.
right, exactly. So, I mean, we get the time to play around with this, I just want to make sure we
Yeah.
get it done right, so.
But we need the flexibility.
Yeah.
Any other comments or thoughts, Peter? or Dana?
No, I think we just need to straighten it out. He was much more generous than he ever thought he could be.
You know, not the many, many years I've been involved with this, never had anything. Well, Futures once got a big chunk from it. In the state, we didn't know about Piscataqua. Were you there then? Piscataqua Bank just called up the high school one day and said, I think that was around 900,000. Come on, who should we make the check out to? We're like, who is this person? And it had been, I think, the will had been, was over 30 years old. So it was,
Huh, no kidding.
these are the fun projects.
Yeah, exactly.
But now, what was the other one?
The McHale Scholarship.
Oh, yeah.
You know what that one's about?
She had wanted to increase the awards, which we came back to the trustees, and the trustees were fine with the increase from 7,000 to 10,000. But Tom had some concern and wanted to talk to you about the part that, you know, she had said, you know, maybe once these are awarded after this year, we can roll it into the community, one of the community scholarships. Tom had some concerns with it.
Well, that also would have to go through the AG's office. But how much would be left after?
It would be a small amount, I think you figured.
Just ballpark, so, you know.
8,000 maybe, 7,000, yeah. Again, depending on the market, there might be an adjustment
that-
one way or the other.
Since we did that settlement agreement, the market was in a much stronger position, so we kind of estimated that the payout would.
Right. And it could be, I mean, if there are losses
But
this year.
it's thousands, not 500
No,
is the point.
yeah, fortunately not. I mean, the market's.
She is just done.
Yeah.
She got 66 applications this year.
Wow.
And she's just a super nice person. I worked with the family,
Yeah.
sadly, when her daughter passed away,
Yeah.
so I've been involved with them since she and her ex-husband created this. And
Yeah.
we run into each other at Hannaford on a routine basis where most businesses transact. So at the beginning, she wanted to know the kids, but it's been years and years, and she's just, it's a job to her, and it's a job she wants not to have anymore.
So the sole issue is that, consistent with the non-judicial settlement agreement we did with that one in 2019, it's being paid down, it's just going to be this odd amount left after this year. So without doing anything, we can simply wait till next year and the last amount is paid out and the thing closes itself out.
Which is fine. I don't think she cares one way or the other. She just doesn't want to have to get 66 applications next year or to
Yeah.
deal with this. And she also, in all these years, goes to the award ceremony, and she brings flowers for the kids that
Oh,
are
wow.
going to get it. And
Yeah.
so it's just all very,
I get it.
so that's why she's done.
And I frankly, would love to just take the money and put it into the community.
I'm thinking like you.
I just didn't want to do it if we're not permitted, so.
I can, when I'm talking to Diane, see if, on our end, it wouldn't be a lot of paperwork if they agree to it. If not, then we
We'll
can
run
just
it out
pay it
next
all out
year,
next
all of
year.
it.
And then I would let the high school know, have somebody else pick the reserve. And actually, it's kind of an illegal scholarship now, because you're not legally allowed to administer single gender scholarships. But this was, I don't know when that case came down, but this was very old, so.
Yeah, well, we had that problem a while back.
Yeah.
Remember, that was, all right, well, so my thought on this would be if you talk to Diane and she says, oh, that's fine, send us over the thing, and all you have to do is put one together and send it to her, then we'll do that.
Okay.
But if
That
it's,
would be a two-sentence thing.
Yeah.
So,
and just indicate which one of the scholarships it will go into. And I don't know whether you need to talk to her about it or not, but.
Higher education, I
I
think,
think
is what
hers
you
was
had
at
said.
higher education, so, and we have one that squarely fits, we have something available to put it in
Yeah.
by the community scholarships.
Okay. That was a simple one.
Okay, I can just email you back after
Great. Great.
Okay. Always a
Thank
fun
you.
way to start the day.
Thank you very much. Go home and take a little nap now.
I don't know, I was at school board last night, and I said, this was, like I said. Have a good day.
Thank
Thanks, you
you.
too.
All right, well, let's quickly go through some housekeeping then. We have the minutes of the April 19th meeting in your materials. Do I hear a motion to approve them?
I'll move approval.
Second.
Any corrections, additions, deletions? Hearing none, I'll call the question. All in favor?
Aye.
Aye.
Unanimous, okay. The donation policy, I just included that as an informational item because you'll recall that we met with Suzanne at the April meeting and went over the changes that we wanted. The changes were submitted to Councilor Cook. They were okay with her and her committee, and then they were approved by the City Council on May 1st as we drafted. So the policy does not apply to the trustees.
Yeah.
But you have a copy of the final version for your perusal. The Daniel Street Trust request. Recall Daniel Street Trust was set up when Connie Bean Center, the original Connie Bean Center, was sold several years ago, and that last year the city manager and the city council came to us and wanted to disperse all but $20,000 from the trust to assist in acquiring the community campus property. And that remaining $20,000 was set aside or remained from the original trust agreement, which provided that there would be that amount of money set aside for promoting veterans and military service and that type of thing. So the request is to reimburse the city for sums that they recently spent for that purpose.
So moved.
Second.
Any other discussion? Hearing none. All in favor?
Aye.
Aye.
And the chair votes aye. Unanimous. Okay. We got one check to sign, that's it?
Yeah.
What are we signing?
Just to let you know, the balance in that was 13,000 because they had done some flagpole work like 2 years ago or whatever. So it'll be about 12,000 once this comes out.
Okay.
Thank you very much.
Are there any more checks to sign?
There's
beyond?
one.
Okay,
It's a really big one.
really big
A
one.
really big one. This is moving all the monies that are sitting over into the investment fund. So this check is for over $1 million. It's the Mortimer. It's some donations and funds that have been coming in for futures that are just sitting there. So if we take all this and move it over, it will earn more money with the investments. So I've already talked to TD, and they've given me the instructions. I'm going to overnight the check to them, and they'll deposit it into the proper funds. So it'll be a nice big increase to the scholarship fund and others, so. And that still leaves about $250,000 in the checking account, but those monies are the Marine Maintenance Trust, the Cable PPTV Trust just got
wanna
some
see
money
it?
in.
Don't get to sign $1 million check every day.
I know. And how great that's going into the investment funds, you know? It's just,
Well,
Although the timing might not be the best.
sometimes you make money by not losing it.
yeah. Maybe this will be good luck.
Well, listen, when you give them, we'll tell them, we're giving you $1 million.
Yeah, I know. Do something good with it.
No, don't lose it.
Don't lose it. Well, he's not taking it. I'm overnighting it to a special, yeah.
What was the first check to 17,000? Who was that from? The first check?
The first check was for $1,000
Oh.
reimbursing the city for the Daniel Street Trust for the veterans event that they had.
No, but the one you had Tom just.
That was it.
Oh, that was it?
The one we just voted on.
Yes,
Okay,
yeah.
thanks.
Those are the only two checks I have.
So what,
And I do have a few donations to tell you about, which is
Oh,
good.
good.
Yeah. The family of Russ Wilson has added another $1,000 that they, to put into the Sunset Trust that they have to be given out this year. I guess they have another student that Russ knew or whatever, and they wanted to make sure that they had enough to be able to include him, so they're giving an additional $1,000. So instead of the two $1,000, it'll be three $1,000. So they gave us a $1,000 check. We received a check for futures for the $118,000 that comes in every year for administration and all of that, from the school department to be deposited into the trust. That's from the,
charitable
yes,
foundation?
yes. We received a $500 donation from Piscataqua Savings for the futures.
Really?
Yep.
Thank you, Ben.
And we received a $100 donation for the community tech through the online donation.
Terrific.
Great.
Let me go see if they're here. That's everything that we needed to cover, right?
Well,
Oh,
a couple more quick things.
Yes.
One is, just a reminder that you should have received an email about a week or so ago of the city holding its cultural competency training on
Saw that.
on the 30th, May 30th, 6 to 8,
Is that next Tuesday?
next Tuesday. And then secondly,
Is it mandatory?
no, it's discretionary. But I would like to set our pick meeting dates for July, August, September, because we have June set, but we don't have anything set after that, so,
Really?
yeah.
yeah. We did up until June because we knew Dana was coming back and then we were going to wait.
Okay.
So we are scheduled for June 21st right now,
Okay.
and
If possible, typically Wednesday mornings I have a conflict, so
Okay.
Tuesdays or Thursdays would be.
Yeah, I don't want to do Thursday then.
all right, and Tuesdays are good for you?
Will the 21st be all right, or do you want to try
Yeah, no,
to-
that,
Okay.
I have it on the calendar.
Okay.
All right, so how about in July, the third Tuesday would be the 18th, but I'm traveling that week, so can we do the 11th?
Oh, how about the 25th?
I'm still,
You still gone?
yeah, I'm
I
going to Sweden.
could do the 11th.
Is there a better day that week for you?
No, that's fine. I mean, I'm just worried about the 11th, whether we'll have,
I don't know what will, I mean, we might. If we have everything, we might, you're thinking of like all the bank.
yeah,
Yeah,
you know.
yeah. I'll make sure, everything that comes in, I'll make sure that I get it done.
Okay,
By the way, I hope he's bringing the quarterly reports, because I
You didn't print it. He said he was going to bring copies.
Good.
Okay.
all right, so August, the 22nd, or the 15th, which one do you prefer?
I got a conflict on the 22nd.
15th then?
15th is good.
Okay.
So it's August 15th. And what was it, the 11th in July?
Yes.
Yeah, July 11th, August 15th.
September 19th?
Yeah, is that good for you, Dana?
Oh, I'm in the wrong month. Sorry, hold on. No, I'm away.
What works for you?
19th and 20th are both bad. The following Tuesday is fine,
The 26th,
26th.
is that good with you, Peter?
26th?
Yep.
Yeah.
And then, when do you head south again, Dana?
Not till November, December.
Okay, well, let's at least do the October one then. 17th or 24th?
Either one.
17th is,
All right,
Okay.
okay.
Good.
Wait,
So,
let me go see.
July 11th, August 15, September 26, October 17.
Yes.
Excellent. Good morning.
Good morning. Hi, John.
How's everybody doing?
Good, how are you?
Great, thank you. Good to see you all. Let's
We
see.
have Washington represented here.
Yes. I had to get out of
I
there.
think you better go back to
If I
Washington.
heard debt ceiling one more time, I might just cry.
Yeah.
Well, we expect you to tell us today exactly what's going to happen.
I don't know. Somebody took a U-Haul truck and tried to drive in and tell them what they thought.
What's that?
Someone took a U-Haul truck and tried to drive into the White House
yeah.
and tell them what they thought.
When did that happen?
The other night.
2 days ago.
I'm out of
I
touch.
could have told them that wasn't going to work.
Did they determine whether it was intentional or not? Because they were still
it was.
questioning it.
Apparently he had Nazi flags and some other stuff in the truck, so it was some sort of unhappy person.
All I heard was he told authorities he'd been planning the attack for 6 months, but the only image I saw on TV was a U-Haul type truck sort of wedged between two barriers, so it didn't seem to be the best thought out plan, but
Yeah. That's generally the way it goes with most criminals.
yeah.
They're not the brightest.
Did you print out those other things?
Which,
The materials that,
I think they're right here. I think they put them right in
Okay.
your packet for you.
all right. So that's
Yeah, so in the
That's
packet,
a draft.
Oh, here,
there's
okay.
kind of 3 presentations, if you will. There's the report Suzanne had been preparing for the last 6 months or so, a draft of a new report, which we can chat with you about, and then my traditional deck, which I will mention, Peter, is 8 pages shorter than the last one, and I'll
Well, I will tell you that
Working on
I got it, I didn't print it because I knew you'd bring us one.
Good, good. And I will continue to do that.
So
Curious
just,
on this one here,
which one's that? Peter?
The pie chart.
the pie chart says March 31st. Why not April 30th?
It's quarter end, right?
That's quarter end. I'm not sure. Let's see. Where are we? I don't know why we didn't bring April 30. I can do April 30 and get it for you. I
Yeah.
may have not done it because I was working on the draft.
Yeah, so let me
As a
just as
replacement.
background, you recall that last meeting or so that we discussed that I was going to contact Suzanne about changing the format on these to give us performance figures, not just numbers. And this is her draft of that. We tried to send this through the TD system, which is challenging.
It's so secure we can't get it.
But so what I'd like to do, I think, is to have John and Suzanne do their overview of the performance report, and then we can talk about how we want to tweak this or what additional changes we want to make to it. Does that make sense? Okay, you have the floor.
Thank you. With that, I will ask you to turn to page 4 of the larger deck. This page specifically speaks to the scholarship fund, but I will remind you that all of the portfolios are now in the same investment model. So everything I say specific to scholarship applies to the other 3 portfolios. The only differences would be very slight differences in performance figures because they rebalance quarterly at slightly different times. And that's really it. So I won't take you through, all 4 portfolios of the same reports, but we can go into any detail that you want. If you look at the right side of the page and you look at that pie chart, I'll remind you shades of blue are stocks and yellow is bonds, so you can pretty much instantly see you're at a roughly 75% equities, 25% fixed income allocation. That's in line with your IPS, which also has a target 75% equities. If you look down to the table to the right of the pie chart, you see the stratification of the portfolio in a little more detail. You'll notice within stocks, which are the first 4 bullet points, your largest holding is in a large cap core strategy. That's the S&P 500. You've got a tactical allocation to the U.S. large value dividend style. Below that, you've got a 5% allocation to SMID, that's small cap and mid cap. That's actually perfectly in line with your IPS. And then below that, you've got a 5% weighting to international. International is the biggest deviation to your investment policy, where you have a target of 15%, and you've got 5% represented in this portfolio. Below that, you've got your fixed income components, a very small but not zero allocation to high yield. That is in the bank loan and specifically labeled high yield category, so 2% there. Your largest bond category is an intermediate bond, and consistent with your investment policy, that's through an allocation to U.S. Treasury securities and investment grade corporate bonds. And then the short bond category is all U.S. Treasuries, and then a cash balance. As you look down this list, you'll see, you've got diversification not only by asset class, but by style within asset class, by market cap, as well as by geography. So your portfolio remains highly diversified. It also reflects TD's current tactical thinking, and that has been true for the duration of the portfolio. But right now, TD's asset allocation guidance on a tactical basis is to be slightly overweight U.S. large value, and you're getting that through the roughly 10% allocation to that style. Slightly underweight small and mid cap. And so where you've got a 5% allocation, which is consistent with your IPS, a 75-25 portfolio for TD at times might have as much as 10% in SMID. So we're slightly underweight SMID. And then on the fixed income side, where we have a slight overweight to intermediate bonds, then a slight underweight to high yield. And that is similarly expressed in your portfolio today. Just a couple of final comments on fixed income. Your fixed income holdings have a AA average credit quality. Okay, so very high, despite the 2% exposure to below investment grade. Your average credit rating is AA, so very high credit quality. Your duration is 5.4. You can think of that as an average maturity, so essentially a 1 to 10 year portfolio from a maturity profile, and predominantly U.S. Treasury securities, so you've got an overweight quality in fixed income. I'm not recommending any changes to the portfolio at this time. As I look forward, I hope that there's an opportunity to probably add to international. We have no REIT exposure in any of the portfolios. That's the other difference to your IPS, where you have a 5% target weighting to REITs. Being underweight REITs has been beneficial to the portfolio during the, almost 2-year duration that you've worked with us. Obviously, REITs were negatively impacted significantly by the pandemic and the current hybrid work environment that so many people are, and commercial real estate has been struggling. So that's been a benefit to the portfolio. And then, we'll see, to the extent that we get the slowdown and the delayed impact from the increases in the Fed funds rate that the Fed's been engineering for the past 12 months, we may see a really compelling opportunity in high yield too. So your IPS doesn't have a specific target to high yield, but as TD's tactical views change there, those might be 3 areas where I'd recommend a change. But right now, I'm not recommending any changes to the portfolios. With that, let me turn you to page 6, which speaks to performance. And if you look at the table on the left, as you go down that table, you're looking, you can see on the far left column, you're just looking at different time periods. So the first 4 rows are showing you the last 4 quarters. And then you get to trailing 1 year, and then the custom period at the bottom is just since inception, May of 2021, late May. The middle column, titled TWRR, that stands for time-weighted rate of return. That's the total return of the portfolio, so that's price changes plus income that you would have received, dividends on your stocks, coupon income on your bonds, less the 20 basis point fee. So those are net of fees figures. So you can quickly see, as you just look at the last 2 columns, we've had a really nice recovery starting in really November of 2022 that has carried through the first quarter from what was 2022 was the worst investment year that we've seen in decades. A combination of a stock market that was down 15 to 20% combined with a bond market that was down north of 10%. Because of the increases in interest rates. That was really the focus of our last meeting. What has happened since then is the bear market in stocks, we don't know if it's over yet. Stocks are still down from their all-time highs, but have recovered tremendously, as you can see in those last 2 quarters. The jury's still out on whether we're still in a bear market or not, but it's been a strong recovery. And if you look all the way down at the bottom, the portfolio would have been down about 14% in 2022, so we've gone a long way to recovering what's been a challenging environment since we opened up this portfolio. If you look at that bottom row,
Where are we looking?
custom period,
Yeah.
minus 2.26, so
Yeah.
that's the performance from inception. you can compare that. There's two benchmarks down below. The benchmark that is labeled COP-IPS, that's City of Portsmouth Investment Policy. So that compares the portfolio's performance to the target weightings in your investment policy. So from inception, we've done better by 40 basis points. It's not even a 2-year history yet. Not a time for congratulations or disappointment, but it's nice to see that the asset allocation has outperformed the IPS.
Where's the 40 basis points?
Dana, do you see the negative 2.63
Yeah,
versus the negative 2.26?
That's 37.
Yes.
We're rounding.
You are correct.
versus what, the 2?
2.26.
Oh, okay, thanks.
Yes. Yep, you bet.
All right, thanks.
Yep. The deviation, your IPS, and I am intellectually in agreement with this philosophy as well, seeks to mostly invest in passive strategies, index-based strategies, right? So unless we are deviating dramatically from the target weighting in your IPS, your performance shouldn't be dramatically different. We hope that TD's tactical decisions over time add value. To date, the biggest differential that you see in any given quarter between your portfolio and your IPS target is going to be based on the international weighting, where we've got about a 10% lower international weighting than in the IPS. For most of this time period, that has benefited the portfolio. Where it didn't benefit it was in just this first quarter. And if you turn to page 8, I'll show you that. Page 8 is showing you all 10 holdings in the portfolio. So if you look at the far left column, it's each product in the portfolio. These are all passive strategies. If you look at the middle column, you'll see the style. That is how this report is actually ordered. So you see your largest holding on top is the S&P 500. And if you look at the far right, I'm showing you the performance just for the first quarter. So this would be year-to-date through 3/31. S&P 500 was up almost 7.3%. If you go right below that, you see the tactical allocation to the large value strategy up just under 1%. So that tactical allocation did not benefit the portfolio in the first quarter. International actually was your best performing equity strategy. So in the first quarter, we would have been better off at your target of 15%. All the quarters prior to that, international was lagging. So that's really the variance you're going to see right now. And then below that, you see the next 5 are all your 6 fixed income holdings. This is the first quarter since inception that all 5 of those have been positive. Okay, and that's a function of we've finally gotten a stabilization in interest rates for the most part. In the first quarter, the Fed took the Fed funds rate up to 4.75. They took it up to 5 in the second quarter, so that's not reflected in these numbers. But remember, in the first quarter, it may seem a while ago now, we had one of the largest bank failures in the history of the country, Silicon Valley Bank. That event caused longer-term rates to fall. And I'll remind you that bond prices move inversely to interest rates. So when rates fall, bond prices go up. So it was actually your longest duration strategy, which is 4 up from the bottom. Your investment grade corporate bond strategy was up just over 4.5%. And you can contrast that to the line right below it, 3 up from the bottom, positive 1.6% for your shortest duration strategy, the 1 to 3 treasury. So positive across the board, but it was actually the longest maturity fixed income investments that did best year to date so far. And then second from the bottom, you can see high yield has held up pretty well despite a slowing economy. So that's
Good job.
yeah. That's every portfolio has the same model today. Again, not recommending any changes. It's been a really good start to the year. And I'll pause there for any questions. I want to quickly take you through the overall market and economy update and tell you what TD's thinking. But any questions there? If not, I'll ask you to turn to page 25. And I'll just mention, as you're turning the pages, that quarter to date, so Q2 '23, all the portfolios are up about 1% for the quarter. So as you look at the performance figures on the dashboard page, we'd be up about 1% higher today. We'll see where we are at the end of the quarter, but, you know, the strong start to the year has continued in April and in May.
So up 1% for second quarter?
Exactly. Yep. So Q1 review, I'll go through this quickly. I know this is rearview mirror, but remember, the big story has been inflation, right? The Fed raised interest rates from roughly 0 to just over 5% in a 12-month period, the fastest we've ever seen them increase interest rates. The reason they're doing it is because we were seeing price increases on a year-over-year basis approaching 9.5% to 10%. This is an untenable situation for two reasons. One, the Fed's target is 2%, so, dramatically above that. In addition to that, the average American doesn't own a house, doesn't own stocks, and is living paycheck to paycheck. And their wages are not going up 10% a year. So when food and energy and everything else this is a real problem. So was the Fed behind the 8 ball in raising interest rates? Maybe. It's easy to be critical of the Fed. It's kind of an impossible job. But they responded dramatically. And inflation is now 4.5% to 5%, so it's coming down as expected. That did affect the banking sector in an unanticipated way. We've had 3 banking failures now at this point. Dana is well versed in this, given his role as bank trustee. Banks have 3 primary risks: credit risk, interest rate risk, and liquidity risk. And the failures resulted from 2 of those coming together: interest rate risk and liquidity risk. The interest rate risk came from banks owning very long duration bonds as a way to get some income when rates were really low. And as we discussed, when interest rates rise, bond prices go down. And in the case of Silicon Valley Bank, they needed to raise capital. And unfortunately, they needed to raise capital in a world where people can pick up their iPhones and move money from Bank A to Bank B in seconds. And they saw a run on their bank that caused them to fail. And it's unfortunate because this is one of the most basic risks in banking. As Dana knows from my prior Treasury days, every bank Treasury department spends hours modeling out this risk. These were just extraordinary times. In the case of Silicon Valley Bank, they were lax. The truth is, in the U.S., we use what's called a fractional reserve banking system. What that means is, no matter what bank it is, if every customer went in and wanted their deposits back, there isn't enough cash. It's banks hold roughly 10% of the cash that they, have on their balance sheet. Every bank is susceptible to this risk. So the Fed did what it needed to do, and it backstopped all deposits, and we think has abated this crisis. That actually benefited your portfolio's performance in the first quarter because it brought interest rates down, and that's why you saw those kind of 2 to 3% returns on your bond. We don't think there's any scenario where the banking stress is going to be positive for growth. So as we debate whether the U.S. is going to end up in a recession or manage to engineer a soft landing, that's a risk. Going down to the market section here, growth stocks have been by far the outperformer this year. I'll show you that on the next page. And the U.S. dollar lost ground in the first quarter. That's why international, in part, did better. And if you turn to page 26, I'll just highlight a couple things on this page. So you've seen page 26 before. It's a summary of the index returns, bonds on top, equities in the middle, international on the bottom. If you look in the equity section, so middle of the page, and then go down to the third row, U.S. large cap growth. In the first quarter, so the first 3 months of the year, you can see large cap growth was up 14.3%, large value up 1%. That's a complete reversal of 2022. If you look one column to the right, the 1 year column, you can see large cap growth was down almost 11% for the trailing 12-month period, large value -6%. For the past 3 year period, nearly even, and then longer term growth has outperformed. This has been a real surprise this year. The stocks that did the worst in 2022, which we can somewhat simplistically describe as the tech sector, and perhaps the overvalued tech sector, corrected dramatically in 2022, rebounded dramatically in 2023. The energy sector, which was by far the biggest outperformer last year, has been among the worst in 2022, despite the fact that earnings have been strong. And then banks also fall into the large value sector, so that's dragged that down. We think that's mostly behind us. And then if you see international, third row from the bottom, it's not that international companies are actually growing that fast, but we saw about a 10% decline in the US dollar in the first quarter. And when we translate those foreign earnings into US currency, a falling dollar makes them look stronger. Okay. If you turn to the next page, this is the periodic table of sectors. Each column is a year, with the exception of the far right column, which is only the first quarter. And if you don't even look at the labels, but you just look at the colors, one of the things that always stands out to me on this table is how unpredictable it is to figure out which sectors of the economy are going to do best. If you just look at the yellow, which is energy, it's either been the worst or the best, for the most part, over this period. Up 65% in 2022 and near the bottom of the pack in 2023. So it just shows you how, and this is one of the reasons why I'm a big fan of what you as an organization also prefer, which is this passive approach to investing, because to outsmart the S&P 500, you really got to figure out on a quarterly basis which sector is going to outperform, and one look at this chart shows you how tricky that is. If you look at the bottom right of 2023 year to date, you can see these are all the defensive sectors. Financial, because of the stress that we just talked about. Energy has really just been a reversal of the bets from last year. The energy companies are actually reporting really good profitability. Healthcare, utilities, consumer staples, these are all the defensive sectors. So the stock market seems to be very much making a soft landing bet as opposed to a recessionary bet. If you turn to page 28, this is a graphical depiction of the change in rates that we've seen. The blue line goes back, it's basically 12 months ago to the end of the first quarter of 2022. The green line is the end of the first quarter of 2023. You can see the dramatic increase in rates. We've talked about that. The bigger question is, where do we go from here? TD's view, and this is not inconsistent with Wall Street in general, as well as what the Federal Reserve is telling us, is that the tightenings are probably done. The Fed is not coming out as clearly in saying that, but they haven't specifically used the word pause, but we think that's where they are. So that means the short end is probably done. The question is, how quickly will they start cutting? Once the Fed stops tightening, ease usually follows within 6 to 12 months. The yield curve is currently telling us, or predicting, that the Fed will start easing before the end of this year. That's not, cast in stone, but that's what the shape of the yield curve telling you, by virtue of the fact that the highest rate on the yield curve right now is the short-term rate. TD's view is a little bit more conservative. We don't think the first ease will come until the first quarter of 2024, and you can see that on the next page. This is our interest rate forecast. The top row is the Fed funds rate. The next rows are the U.S. Treasury curve out to 10 years. We are currently right in the middle of that top row, second quarter of 2023. Q2F stands for forecast, so that's where we are now at 5.25. You can see we don't see any more tightenings as you go to the right. We see a cut to 475 in the first quarter of 2024, and a 200 basis point drop by the end of 2024, so down to 3.25. Okay, we'll see how that plays out. The forecast is essentially assuming, and if you turn to page 30, and I'll wrap up here, the very top line is our GDP forecast. And if you just look at the far right, the three columns from the far right, 2022, roughly 2%. We're forecasting GDP growth of 1.3 for 2023 and 1% for 2024. So TD is not forecasting a recession, but we are forecasting a very slow growth environment. And so to the extent that the Fed can get the inflation rate down to 2%, and that's the very bottom row here, and you'll notice it'll, by our estimate, take until the end of 2024 to get to 2%. An economy growing at roughly 1% isn't an environment where you'd expect to see an inverted yield curve like we have today. So it makes sense that the Fed would look forward at a slowing economy and start to ease rates once they are extremely confident that we're past the inflation problem. And that does seem like the most likely scenario. So that's the conclusion of my formal comments. Happy to answer any questions on anything in the deck or anything that I said.
Just a quick one, just so I
Yep.
understand this. On that one, you were just talking about that chart. Was this done before the 2022 year end? Because you have 22 as a forecast.
That's because, no, this was done after that, Dana. It's because GDP gets reported on such a lag that you get the advanced number. I won't get all the names right, but there's 3 releases of GDP, and we've only gotten 2 of them so far. I wouldn't expect it to change materially from the number you see there, but, yeah. Which is why, incidentally, that, we talk about whether we're in a recession or not. The National Bureau of Economic Research, which has the job of officially dating recessions, it's so backward looking, we're often on our way out of them by the time they tell us one started. And it's because the U.S. economy is complex. This data gets revised quite a bit. Tom, if no other questions, then we can move to
Let's get the fun part.
the fun part. Yeah, we're making progress, right? These are.
It's pretty comprehensive.
Wait, that one's yours. We mixed our notes up. These are yours. Okay. So, Peter, you pointed out the pie chart is March 31, but this is exactly the same report that Judy was putting together for you. All it has is TD's mark of legal and compliance, putting their handiwork all over it with lots of disclosures and notes that make your head hurt. The blue one has different content in it. As Tom and I were talking about, the one with the pie chart really just gives you beginning and ending balances. And it doesn't help you much because I don't know the contributions and distributions that have been made throughout the month. So I can't put that data in here for you. What I can do on a quarterly basis is include the performance information which is quarterly, not monthly, because we have the reports that John puts together for you. So Tom and I talked about me putting together take a stab at it and see if, we'll put a draft together and then you tell me what you like, what you don't like, and then I'll go back and try again, and we'll do a little trial and error until we come up with what you do, what you like, and then we'll go forward from there. So this is, if you look at the top, the lines, obviously the first column are the different accounts. Then we have the market values as of the March 31st quarter end date. The year-to-date performance for each, the benchmark for each account, then the quarter one performance for each account, which is the same as the year-to-date because it's the first quarter, and the benchmark. And then inception to date, which would be from the very beginning of the investments. And then the corresponding benchmark. And then to have a graphical view, I did the 3D bar charts below. And you can see that the numbers correspond with the spreadsheet above. The far right one, I can correct. I just had a little trouble because of the negative numbers. The names of the organization didn't populate and the numbers didn't populate, but I can fix that. Thoughts?
Yep.
Peter
Peter?
has one.
Yeah. Will you provide magnifying glasses? I'm being facetious.
We're not that facetious.
There's a lot of data, so I can take some out.
The next, can you have a total of all of them?
Yeah.
Total market
Oh,
value?
yeah, sure.
The fifth line there.
Yeah, absolutely.
But is this in the direction we're going? Because this has the performance
Yeah.
numbers we're looking
This is a
for.
definite improvement. I got a few questions or comments.
Sure.
Go ahead.
First, on the benchmark. You have the two benchmarks, the manager benchmark and our investment policy benchmark. Just talk to me a little bit about that so I know which one we want to see here.
Yep. I'm going to, you don't have to turn here, Dana, but I'm going to tell you,
I know one of them, I thought the manager benchmark was a 75-25.
they both are. The difference is explained in, if you think about the performance report we went over, the difference is explained in detail in the footnote that is footnote number 3 on page 7. You don't have to go there, I'll tell you what it is.
You
but
really
it
need magnifying glasses
It explains
for
what
that.
they are. So the manager benchmark is, my system has a default benchmark for any portfolio that, is 20% stocks, 50% stocks, 75% stocks. That benchmark is 60% S&P 500.
Yeah, I read that.
15% MSCI World ex-US.
Yeah,
So there's the 75 stocks. And in bonds is the Barclays Aggregate Bond Index.
yeah, I get that.
Yep. And then following that, it says COP-IPS refers to a blend comprised of.
Where's that? That's what I
It's-
missed.
Yep.
Oh, here it is. Okay.
Exactly. Yep. I customized that benchmark specific for your reports to match the target weightings in your IPS.
Okay.
So your IPS has a 50% target to large cap core. And then on the bond side, you don't get that specific. And so I'm using the US aggregate as well. And then you've got 10% to international developed,
Yeah,
5% to SMID, 5% to REIT, and 5% to emerging market.
okay.
So that's the composition of
Okay, and you,
the COP-IPS.
okay, that's helpful.
Yep.
It's more targeted to your portfolio.
So my question is, in your view, on this report that you're generating, which benchmark would be most appropriate for us?
The COP benchmark, the COP-IPS benchmark, and that's the one I used.
Oh, that's the one you use,
Right,
not the
so-
manager one?
Correct, so that it says
Okay.
IPS bench. It said,
Okay,
originally it says COP-IPS bench, but
Okay.
it didn't fit in the,
okay,
it didn't fit in the legend in the bottom.
okay.
I would have had to make the font smaller
This is definitely helpful. One comment, you definitely, the total Peter suggested, and if possible, could we throw in a year-to-date column? for-
That's the first column after the market value?
Oh, you have, okay.
This is the first quarter, so you get.
First quarter is
they're
the
duplicated,
year-to-date.
so.
Then you get quarter one, okay.
So it
You
just
got it.
happens
You
to
have
be
it.
that
Yes.
year-to-date and quarter one are the
They're
same.
Yeah. Perfect.
So next quarter, you'd have year-to-date, quarter two, quarter number two, and then inception to date.
Right.
We're going to throw you a curveball, though.
Okay. I have my bat.
So, let's get a good hit then. We're going to be sending you a check overnight for over $1 million.
Awesome.
Yeah, but that's going to screw up this report
Why?
because and it's all in scholarship, correct, Judy? The check.
Most of it, yeah, yes.
So when you get that, how are we going to know that the increase in scholarship was because of additional monies that we just acquired and not growth?
Oh, because it's time-weighted rate of return.
In other words,
On the report.
Should be.
this
the answer.
report is showing performance, and it's exactly as Suzanne said, it's weighted by time. So when you add $1 million to a portfolio, it has no impact on performance at that point. You're right, the balance goes up.
Yeah. So
On this report, it would impact it. Your question definitely applies to this report, because this is just showing you a simple percentage difference between values, but in terms of performance, it won't
It's
affect this one.
time weighted, and that was exactly what
Yeah, exactly.
I've been after.
So the ones we get in the mail are going to just show that increase in the value. That's why we wanted the performance thing, so.
So John mentioned earlier that the time-weighted rate of return is the price change for each manager, and then the total return minus the fee. So these performance numbers are the performance of each manager on a percentage basis. It doesn't have to do with the market,
Okay.
the market value.
okay.
But
Good question. Yep.
So is that
Got you covered
like a
there.
single or a bunch? Like, what does that count as?
But it's not just the performance of each manager,
It's composite, not composite, that's a bad word.
but it's time weighted, that's the key.
Time weighted, right.
From the time of that $1 million increase, you're measuring performance of that $1 million plus the performance of what was there before,
Right.
Blended.
blended. Yeah, which is critical. Terrific.
So anything else you'd like to see in this?
Okay, one more question. This is excellent.
Oh, thank you.
You mentioned we can do this on quarterly basis.
Yes.
Can we do it on a monthly basis?
I don't think we can because the performance is generated quarterly. I don't think we can do performance monthly.
I'm just curious. I mean, for me personally, quarterly's fine, but I was just wondering what the options, if someone wanted more at any, or a point in time.
Yeah, performance is generally generated quarterly, so that would be how we would do it. The custody statements are generated monthly.
But I feel it just.
I'll check and see if we
If
can
the
do it.
customer wants to know performance at any point in time,
I'll
you
check.
can't give them that?
I'll check.
Okay. That would be helpful to know that.
I'll check because we call them QPR, quarterly performance reports, and they're automatically generated. But I'll check and see what we can do.
So if they are available, we prefer to get them monthly. Is that what you're saying, Dana? Or are you just curious about it?
I was mostly curious. In a volatile market, I think monthly's great, but in general, I'm fine with quarterly.
How about you, Peter?
I always like to see things monthly.
Well, now, if you want them monthly, how do you want this presented then? Like the previous, you want year-to-date, previous month, inception to date?
Very good. At that point, for me, year-to-date is
You know-
fine.
What do you mean year-to-date is fine?
If, if it's month 5,
Yep.
the year-to-date number for me against
Okay.
is adequate.
So you don't need a quarterly one as well? Okay, yep.
I don't.
So you would have the monthly, the year-to-date, and inception to date.
Yeah, I don't even need the month. Well, you're talking monthly, that 1 month? See,
Okay, so monthly and inception to date.
no,
I'm more
year-to-date.
interested in year-to-date than inception to date, but that's just my opinion.
Yeah, I
Okay,
agree.
so we don't need inception to date. Okay. So monthly and year-to-date.
So if the market value was being updated monthly, the year-to-date column would stay the same.
Right.
You could leave Q1 on there until it changes to Q2,
Right,
just for
right,
reference.
right.
We're doing monthly performance. So I'm just trying to figure out which performance we would include. So we would have the monthly,
So in other words, column 2 would update monthly to whatever the month-end value is. The year-to-date column would reflect the year-to-date performance to that month-end.
so we would have monthly and year-to-date. Whatever that month is, and the year-to-date.
Yeah.
Okay,
Right.
okay. And that,
But like John said, if possible, if you can just keep the prior quarter in there, it's fine. For reference.
okay. Okay.
Do you want her to take the last 2 columns out, the inception to date?
Uh,
I think so.
Leave them in for now?
I would think so. You don't want to know how it's performed since they've taken it overall?
Yeah, but I'm assuming we would get that from you on a quarterly basis,
Yes.
right?
You do, yep.
Yeah.
If I
The only benefit to taking it off is it'll
make more room for the
make more
charts.
room.
Yes.
Yeah.
The print will be larger. so. I mean, I'm happy as long as I get the inception of the date at least annually.
We'll get it.
You'll get it quarterly,
Yeah,
so,
so-
yeah.
All right, so monthly, year-to-date, and prior quarter, that leaves me with 3 charts. So
Right.
Yeah,
there's no more room for another chart.
okay. So you think you'd probably be able to do that then?
Yeah.
Okay.
And
I'm sorry, unless I misunderstood, you're not, we wouldn't be putting monthly performance.
if we can get it, I don't know if we,
You'd be putting year-to-date performance as of that month end. So you wouldn't need a new column for monthly, right?
Well, that was the debate, what could or couldn't be done.
oh, right, okay.
Yeah, so as I understand, Suzanne said she isn't sure whether the
Right, okay.
performance is available on a monthly basis instead of a quarterly. If it is, then we'd like to get the monthly in there as well. If it's not, then I guess we just end up with a year-to-date and the,
I gotcha.
Yep.
I understand.
Yeah,
Thank you for
I got it
clarifying
now.
that.
Yeah, now I understand. Okay, I got it. We are all on the same page now. And I will send you a draft.
Yeah.
okay?
And if I send it to you, you can distribute it to the folks?
I can.
And you can
I
open,
can.
and you
I
can
can.
open the emails, so
Yes,
that's
I can.
fantastic. Okay, good. All right, I'm on it.
Okay, so if we get this and we like it, we don't need this from Suzanne anymore?
No.
Okay.
But you'll be
And,
doing yours,
you know, since,
And Judy will still do it?
She'll be doing the one that she did
Yeah.
before this, so, yeah.
do you like blue font, green, red? What do you like?
Multi, four colors.
What
Surprise
color?
'em.
What color do you like?
Well, you got blue here, I'm fine with blue.
Blue is good? All right, blue is good.
This is a big, huge improvement.
Thank you for your
Excellent.
patience in working through this.
One more question for you.
Oh, you run out of questions.
Yeah.
Is
This is, you know, a very meaty, helpful report. Can we get it in print, like, 4 or 5 days before we meet with you on a quarterly basis? I know it came in the email, but like Peter
Oh,
said.
get it printed.
Printed, yeah.
Yes, yes, yes.
Because it's 35, 40 pages, and I like it in color and,
Your pr- you-
okay?
Your printer doesn't print in color?
If I hit the right button, it does.
Yes.
Yeah, that'd be great.
We can have the guys
Yeah.
send it.
Did you stay over in Portsmouth last night?
I did, and I was very fortunate to get on a waitlisted and made it on an earlier flight, so I got one of the last seatings at Toscana.
Oh, nice.
It was very tasty.
Where'd you stay?
The Hilton Garden Inn.
Right in town?
I did drive a little fast to get here. Because last time I got here and everything was, the kitchens were all closed by the time I got here, and I was very sad.
Next time you come, you let me know, and I'll treat you to Gillies.
Gillies.
That sounds like a good offer.
I like that. I appreciate it.
No, I'm serious. Let me know, and I'll take you out and get the skinny on the wealth department.
Very good.
Anything else, John or Suzanne?
No,
I
unless
guess
you
I
have
would
anything
only
for
add,
us.
since you didn't specifically ask, that TD's view is that the U.S. government will not be defaulting on its debt over the next month or so. That's obviously been a hot topic. I was going to say our default view. Our base case, we've seen this movie before, right? This is political posturing. Our politicians are debating raising the debt ceiling in order to pay for funds that they approved for the 2023 annual budget last year. This isn't about spending more money. We're already spending the money. The truth is, the discussion we should be having is, as a country, can we continue to spend $1 trillion more every year than we bring in tax revenue?
When are we going to get down to the big issue of a balanced budget?
Right.
I mean, that's, where's Warren Rudman when we need him?
He's with Paul Songus.
So anyway, just wanted to add that. I meant to mention it in my comments earlier, but Great to see you all.
Yeah.
Thank you very much for coming in.
In your opinion,
And remember, you're on TV, so.
what effect on the economy is it going to have if we default?
Disastrous.
I guess to answer that, you'd have to know to some level of detail to what degree and for how long, but let's just assume that it's for a very short period of time. You know, the stock market would go down, interest rates would rise dramatically, most likely. It would be devastating for the U.S. and global markets because the U.S. is the world's reserve currency. That is an absolutely privileged place to be in modern times, and it's unconscionable that and we can only do what we do because countries like China and Japan are willing to lend us trillions of dollars, right? Not to mention the fact that banks, like we're in the little bit midst of a banking crisis here, banks are required to hold Treasury securities. This came after the great financial crisis and capital changes that were made. So it's really kind of unimaginable. And it would be bad for the markets, and then the government would have to reverse course. And, you know, so short-lived, not good, quick recovery, which is why it will be avoided.
I think we just need to be prepared for that. You know, it's unfortunate that
Yeah, we're seeing volatility now associated with it. We have some clients who, they don't have long-term pools of assets to manage. It's just short-term cash management. And Treasury bills have been a great place to be as the Fed started raising rates, because the Fed was raising rates, you know, almost every month. Bank deposit rates lag that on the increase. So T-bills has been a popular place for our corporate customers to park cash. Yesterday, I bought a T-bill for a client at a rate of 6.05%, maturing in mid-June.
Wow.
Right,
I didn't
and
know
so,
it got that high.
yeah, yep, probably caught the highs of the day. So it's, you know, it's already affecting markets, and so we should expect some volatility around this until it gets solved. But we very much expect it to get solved.
Thank you.
Yep, pleasure. Great to see you all.
Thank you.
Likewise. Thank you. Thank you.
Thank you for coming, Suzanne.
Oh, it's always a pleasure.
Judy, I'm sorry, you got all the answers you needed on the check, right?
Yes, thank you.
And that is going out.
Very responsive, thank you. Yep,
Did that already go in the mail, or
they
that's-
just signed it,
That you signed it?
so
Okay.
shortly, yep.
Okay, great. I'll confirm for you once that gets,
That
you know,
sounds
received
great.
and deposited. Okay.
Great.
Take care, everyone.
Thank you.
Nice to
See you
see
all.
you.
Safe travels.
Thank you.
Okay. So we've signed all the checks,
Yep.
and it doesn't appear we have any public discussion, so we'll open it up to any new matters.
This is a bit of a relief to move this forward.
Yeah.
Reporting.
Yeah, I think there's just a communications disconnect as to what we're looking for, so we're there. All right, I will entertain a motion to adjourn.
So move.
Second.
All in favor? Aye, aye, aye. Thank you very much.